Verizon stock offers dividend investors a yield of 8.08%. That's understandably a dividend yield that has passive income investors excited. But is Verizon's 8% dividend yield safe? That's the question I'm going to answer in this video, looking at Verizon's balance sheet and its income metrics here. So let's get right into it. Starting with one of the most important things I consider when I'm answering this question myself, whether a company's dividend yield is safe, is the ratio of earnings per share to dividends per share. I want to see earnings per share that are higher or much higher than dividends per share. That shows me that the company is not spending more on dividends than it is earning in profits. Longer term, that's not sustainable. You can't pay more dividends than you earn longer term. That's an equation that doesn't balance, right? You keep going negative in terms of that ratio. You're going to run out of your savings account and you're going to run out of your borrowing capacity. So that's why, for me, that's a critical metric, and that's what I have displayed here. In the purple, I have Verizon's earnings per share over the trailing 12 months and then annual dividends. And I consistently see Verizon's earnings in the purple much higher than the dividend per share, more than almost twice as high most recently. So this is a check mark for me that says, okay, one metric that's considers it safe for Verizon dividend investors, but this isn't the only thing I look at. This is just one of the things that if it's a red flag, then automatically I say, okay, you know what, this is not safe. But when it's not a red flag, that doesn't automatically make it safe. So this is just gets us to the next level. The next thing I look at is cash flow from operations to sales. I want to see that the company is generating healthy cash flow from operations out of sales. I like to see a metric of at least 5%, and Verizon has that and then some, right? 28.35% most recently, and for the last 5 years, it's been well above 25% consistently. So, very strong cash flows and very strong earnings for Verizon. Both are green flags for paying out a hefty dividend yield. The final metric I will look at is going to be a red flag. It's a big red flag for Verizon's dividend yield, and that is the total long-term debt compared to the cash balance. Verizon has a whopping $152.85 billion in long-term debt. That's a massive sum, especially when you consider that it only has $2.2 billion in cash and equivalents. So that ratio between debt and cash is troubling, even though the company generates strong cash flow and strong profits. Now, I will say it's not uncommon for companies like Verizon, what I like to think of as utility-like companies, companies that generate strong recurring revenue, strong recurring cash flows on a subscription type model that's very difficult for customers to switch. They tend to have a lot of debt because in order to secure those kinds of strong recurring cash flows likely required billions in upfront investment, and that's the case for Verizon, right? The company had to spend billions developing its wireless network. So I mean, AT&T is the same. AT&T has a massive amount of debt as well. Still, that doesn't make me more comfortable as a dividend stock investor when I know this company has $152 billion in debt. Now, when this debt comes due to refinance, that's when the trouble could arise. Now, up until now, it hasn't been an issue because lenders look at Verizon and say, well, you're generating strong profits and you're generating strong cash flow. we're happy to refinance this debt for you. We're happy to lend you money because we can see you're so incredibly profitable and your business is so incredibly lucrative. However, if there should be a threat to Verizon's business, like you've seen lately from T-Mobile, and then you hear some rumblings from Amazon trying to get into the wireless business, and also some news recently about older wires that Verizon and T-Mobile may have to be held liable for to dig up and fix. So those little things can turn out to be huge things when you're a company that has $152 billion in debt already. Your room for error is very, very small at this scale of debt. So I cannot say that Verizon's dividend is safe with this kind of debt. I cannot say that Verizon's dividend is safe right now. So, yes, it offers a very strong 8% dividend yield, but passive income investors should know that that dividend yield comes with a higher than normal level of risk because of Verizon's massive amount of long-term debt. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.